Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on our EIA show, we're going to go through what happened with the numbers, what does it mean going forward? And we're also going to wrap in what are some of the things that are happening with Russia. We had the OPEC agreement. So just a high level data set, there was not much happening one way or the other in crude. There was a small draw of about 1 million barrels. And right now, and this is one of those weird weeks where next week is going to have some decent makeup numbers because imports were elevated, which made a bit of sense, but exports were a bit lower, and we saw a decent amount of exports that haven't shown up yet. So we should get a decent bounce in the export number next week and a drop in the import number. So that's going to throw off kind of where things sit right now. So that's something that we're going to want to be pay attention to. And then if you remember last week, we were talking about gasoline demand and how there was a big push to get gasoline ahead of the storm. Then you saw this big drop off, but now you have the weather event that's happening. I think it's called Landon, the one coming across pretty much from Texas up through Maine. And there was a big spike in activity this Tuesday. So depending on how that impacts what the numbers look like on how quickly that's replenished, that's going to throw off that gasoline demand. So we were expecting to have a little bit of a bigger drop this week in gasoline demand. It fell, but by a small number. And that means that we could get one more drop before the spike, or we could get one big, smaller increase and then that drop. So that's something that we're going to talk about more in segment 2. So in segment 1, we're just going to go through some of the high-level components. Segment 2, go through a bit deeper into demand, where things are setting up as we go forward, because we're actually getting some decent shifts to the downside on the airline front, but we'll discuss that. And then when we look at segment 3, we want to talk about differentials, because you're starting to get widening differentials in some areas. And it's because as companies are starting to avoid Russian barrels for fear of sanctions, because if you have that barrel and that tanker, and now all of a sudden the cargoes on there are sanctioned, well, there's a lot of problems trying to clear that. So again, those are things that we're going to talk about, and then go provide some color on what happened with OPEC and what does that mean going forward. So looking at the overall picture of what happened in the world last week, as we were saying last week, we saw some bigger increases in some of the storage numbers, and that was what we saw, and we'll cover it again in segment 3 out of Fujairah, out of Singapore. So we did get a decent increase in stockpiles on the product side. And then we did as well on the crude oil side. And that was really just the translation. We had some additional boats showing up in floating storage. And then what was some of the stuff that was in floating storage has come over and shifted into the other in onshore. So the deficit in general narrowed from 92.7 to 81.8. We expect to see that continue to narrow a bit, but again, it's going to be driven a bit more by products and on the light distillate side and gasoline side, as diesel continues to be the bright spot when we're looking at it, but a bigger overhang is growing on the gasoline front on a global level, not just in the US, but we'll discuss that as we progress. On the total crude stocks, deficit narrowed from 32.5 to 21.9. That's going to flatline a bit, and it's just because of some of the timing delays. So you can see we're approaching that the middle range of 17, 19. And again, that's why it's important, in our opinion, to look at both land and floating storage. But the demand will continue to wane in China. It's a mixture because we do have the Olympics starting tomorrow, and we also have the Lunar New Year, which is again going to impact how active they are and where the flows go. Now on the product side, it's a have and have nots, because on the product side, residual fuel, heavy distillates, and light distillates, gasoline, are going into glut territory, while that middle distillate continues to be a big shortfall. So those are things that we want to really parse out and look at ways to maybe invest in, and or how long can that last, or will it continue to last? On the diesel side, that's something that, as we said last year, we expect diesel to continue to be the bright spot. Now, on the gasoline front, imports of European gasoline rose, as we said was going to happen last week, and it's something that's going to continue to be a bit elevated as we're getting some decent builds in Europe. But the bigger problem is, where is it going to go? Because that market is really starting to get have a lot of volume in it. So now when we look at land storage totals, you can see that the deficit widened, from 50.8 to 56.1. And when you look at where it was, the west of Suez, you can see that there was the deficit widened from 39.4 to 43.6. That is going to reverse a tiny bit, only because there was a build in Europe, which is offsetting the build, the draw we have here, but not by any wide margin. It's the east of Suez, as we were saying last week. We expect to see the east of Suez continue to narrow a bit, and that went from 28.2 to 27.4. But just like last week, it's not going to be this huge increase where we're going to go from a deficit of 28.2 to only deficit of 10. Like, it's going to be a million and a half, just based on the timing and where those delays are on the European front. So when we look at what OPEC did, they as we said, really the last few months, we expected a normal 400,000 barrel a day increase. When we look at last month, they only increased by 160,000 barrels a day. And one of the things that we continue to try to drive home, which is why we talk about floating storage so much, this is a target. Nobody has to hit that number. That's a number that you can go to and still be in compliance with the OPEC agreement. But no one said, there's nothing in the bylaws that you have to hit that number. The market is still going to be indicative of what should you accomplish, what should you do. And as we keep talking about, the floating storage number is what's really giving them a pause, because it's like, all right, well, the paper markets were up, the market looks tight, but I have floating storage. So why am I going to increase my production if the market's going to be tighter? I'm just going to sell from what's in floating storage, get a better deal because it's there, it's available, and then I can preserve that. It also helps because there's a pipe shortage, there's pipe cost increases, there's wage increases. So if you can keep your costs low on the supply side and try to live off of some of that excess floating storage, you would do that 10 out of 10 times. So again, that's where we like to balance, what is actually happening when we look at, OPEC production, OPEC exports. And in segment 3, we're going to go bigger into what are some of the exports doing out of some of the key regions within not only OPEC, but also the Gulf Cooperation Council, or the GCC. So when we look at floating storage, the surplus narrowed from 41.4 to 18.1. And a lot of that was driven based on what happened in the west of Suez, where the deficit widened from 2.2 to 4.8. That's a mixture of what happened. We had some nice movements down in West Africa. We'll talk about that in a minute. Again, coming back to trying to sell out and just clear some of the glut in the West African front. And then when we look at east of Suez, the surplus narrowed from 46.5 to 23.5. There was a nice movement in terms of clearing. That's something that we think is going to stay a bit lower, not at the 46 level, but really kind of hang out at this 20 to 25, just given where things are showing up. But we do have a decent slowdown on what is coming into China over the next few weeks. So that's really going to pull down some of that activity when you're looking at the floating storage side. But that's also going to put a bit of pressure on how fast some of these cargoes clear, where some of that pressure resides, which is why I think you're seeing some of the countries being a bit cautious on how quickly they ramp up that production number. When we looked in the U.S., you can see that the crude had a draw of 1.05 million barrels. That's 53.4 million below the 5-year average. Pad 1 had a small build. Then when you look at Pad 2 had a small draw of 790,000. But that's when you look at Pad 2, that's really where a big chunk of this draw really resides. So Pad 2, again, 21.1 million below the 5-year average. Cushing, another drop of 1.17 million barrels, bringing us to 15.1 million below the 5-year average. That's the one that we thought was going to see a bit of a not a huge increase, but the rate of change we thought was going to be a bit higher and come to about 500 to 750,000 in increases, not decreases. So that's where you're starting to get some of that bullish sentiment really coming in, because you're looking at Cushing and you're still having a decent amount coming down into pad 3. And that's where we see a bit of a pause, but we'll talk about that in segment 3. Pad 3 had a draw of 2.7 million. Again, some of the timing delays, because when you look at imports were up, exports were down, but yet there was a draw. But then when we look at the boats in motion, it looked like it should have been the complete opposite, where imports were down, exports were up, which would kind of tie in with where pad 3 is. So I think there's going to be a little bit of a makeup number. So pad 3 could actually have a build, but then the imports exports should be flipped. So this is where, again, it's timing. This is why we look at things when we're talking about them. These are not hard and fast numbers. It's kind of guidance. Where's the direction? Where are things going? What are some of the leading indicators telling us? And then at the same time, what is the 4-week average? Because a lot of the noise that we're discussing between this week and next week is going to be smoothed out, which is why we always like to look at that as well. When we include the SPR, you can see that there was a draw of 2.92 million, as we had additional releases of accrued for loan. And then on the production side, we had a drop of 100,000 barrels, bringing us to 11.5. Now, there is a freeze-off coming. Some of it, like right now in Oklahoma, I think there was a headline came out that said that 22% of natural gas has been shut in. So that's going to be something to watch. Remember, last year we had Uri. Now we have Landon. The question is going to be how cold does it get? Do we get freeze-offs? Do we get some things shutting in? And that's going to be something to look at on the production side, because it could swing back and forth and swing wildly. But again, it's just going to be a bit of a blip, nothing that's going to be continuous, but it will be bullish for diesel consumption and gasoline in the near term. So when we look at runs had another big drop of 1%, bringing us to 86.7%. We were expecting a little bit of a slower move down, but again, coming into what we think is going to be the low point, that 86.5, 86.7, and then really flatlining from here. And it was driven by pad 3, which had a drop of 169,000 barrels a day of throughput. So you're seeing, again, we're coming to kind of that low end, as we talked about last week and the week before. We had some turnarounds coming in and happening at the end of January, beginning of February, and then we'll start to see that ramp up as we get to the second, but probably closer to the third week of February, as some of these assets come back online. Now, when we look at imports decreased by 510,000 barrels. So this is where we were expecting some of this drop, and when we were looking at where imports are, now we should see imports increase. Exports also should go up. So exports are the wrong number. Imports are right here in terms of, again, some of this balancing act that we're talking about. So crude oil imports dropped by 510,000 barrels a day. That's 1 million below the 5-year average, or a little over 1 million below the 5-year average, but it was really driven by pad 3 and pad 5. So pad 3 had a drop of 474,000 a day, and pad 5, 221,000 a day. The pad 3 one is the one that we keep talking about, because we saw some imports increasing or staying elevated. Then they didn't come to fruition. So when you see the drop in stocks in pad 3, a lot of that was on the import side, but then on the export side, we had a drop of 420,000. So you're seeing that there was this big kind of sucking sound coming from pad 3. Now, when you look at what exports did, we had exports actually going up and imports staying fairly flat. Instead, imports were down, exports were down. So again, that's coming back to some of that timing delay. So now when we look at where some of the imports are on the gasoline side, we had gasoline imports rebounded into the U.S. to 252,000 barrels a day, with some additional capacity coming through as well on the Asian front, but we'll talk about that in a minute. So then when we look at where implied demand is, you can see that there was a small drop of 279,000 barrels in gasoline a day, going from 8.5 to 8.2. We're expecting to see now, again, it's just going to be a matter of timing as to when is it recognized. As you know, we had a big increase in Tuesday demand, just as people filled up their cars ahead of the snowstorm, the ice storm. So depending on how long it lasts, how much people don't drive, then again, you'll see some of that pull forward. Distillate, as we were saying, is going to remain strong. We were expecting a little bit of a bigger drop. It was only a drop of 85,000 barrels a day. So we do expect that to continue to grind lower, as we do have some some warmer weather in the Northeast that will help offset some of the colder weather in some of the other areas. But then it does get a bit colder as we go through the middle of Feb. So diesel demand will remain very robust. It'll be well above the 5-year average. It's just going to be a matter of by how much and that timing side. On the jet fuel, again, we are expecting an increase. Now we expected a decrease, and then propane remaining robust, only a decline of 265,000 barrels a day. Still staying very strong, and that's something that we think persists throughout the remainder of the winter. Now, when we look at crude, you can see that we're really hugging the 2018 levels and just going sideways a bit. We were expecting to see the rate of change moving a bit closer towards the 2020 number, or that yellow line. Instead, we're just hunkering and staying pretty close to where we were on the 2018 level. And some of that is a mixture of timing in terms of where the cargoes are going. Again, this is something that we do expect to see this gradually move back up, as we typically have fairly flattish moves when you look at, and again, just looking at timing, when you look at 2018, when you look at 2020, when you look at 2019, you can see that crude storage was fairly flattish, and there wasn't too much up until about March. And then you start getting a little bit of an increase. So again, these are going to be things to pay attention to as we're weighing where some of these storage levels remain. Now, when you look at days of supply, they're starting to increase a bit, and it's just because we have crude staying fairly flat, but yet we have an accelerated decline in reutilization rates, which again is keeping us elevated. So now when we look at total commercial stocks, you can see that we're just going a bit sideways. We were expecting a little bit of an increase closer towards 2018. That's something that we think is still in the cards, especially when you look at gasoline. Gasoline builds are going to be, fairly sizable, especially as they increase targets towards diesel, and we start to get a bit of this run up in February. I should say end of February into March. And it's a preparation for driving season. You get some decent spurts when you're looking at some of the different timings on winter break, spring break. But again, these are things that we'll discuss as we get a bit closer. But when you make one barrel of diesel, you inherently make 2 barrels of gasoline, and you can try to move that and wiggle it within a fairly tight range. But that's why, as diesel continues to be the bright spot, that is throwing off a lot of gasoline, and we're seeing that in Singapore, Fujairah, Europe, and in the US. So again, that's going to create a bit of a problem when we're looking at the gasoline front, and how that's going to really impact us in the spring into summer months, given where gasoline storage sits. Now, when you look at that storage level, you can see that we're continuing to move up. It's not unheard of to be in these levels, so by no means are we in a concerning spot. But you can see that we're moving at the upper range of that level. We do expect to see that acceleration higher as we continue to see some fairly sizable bids, and they'll peak at the end of February as they normally do. The question is going to be, what is the rate of change coming back down? Because as you get into March, you have spring break, you have things picking back up, it's warmer weather, people go out more. So that's where you typically get that demand push. So that's why we're always so sensitive to seasonality, amongst other things, including price. So when we look at distillate storage, you can see we're in a very bullish spot. We're continuing to move at a steady rate. So when you look at the 29-year average, and I have that chart in segment 2, we're just following the same rate of change against the 29-year average. We thought it was going to soften a touch, still have draws, still be bullish, but like flatlining a bit. But instead, things continue to remain robust. And given some of the weather shifts, they should stay fairly strong over the next few weeks, obviously on top of where we are for road diesel. Jet fuel continuing to build. It's just a matter of how is that collection happening. So there's really not too much to talk about on the jet fuel front. When we look at the crude curve, you can see that there's been, obviously another sizable move higher. It's come down a bit, but you can see that we're still elevated, we're still strong. And then on the whole curve is now above $63. So something that is fairly in a bullish situation. And then when we look at the oil in general, still well above 80, going out through pretty much the end of 2022, above 75, pretty much all the way through 23. So again, still a bullish spot to hedge, still a bullish spot to put on some protection, just in case when you look at where some of the spreads are. But you're also seeing the whole curve move up, which is a positive when you're looking at just what is the ability to stay at these elevated prices. And the curve is telling you, look, based on what we're seeing, this is something that's going to be supportive. And you're seeing that backwardation, again, that contango. We're starting to see some softness in the physical market. It's still a lot of geopolitics mixed in and a little bit of softness on the Asian front. But again, for the most part, we're still at a tighter position than we were even 6 months ago. So then when we look on the COVID front, COVID continuing to do its thing, declining in the U.S., still remaining fairly elevated in Europe, but you can see that there's still some noise in that number. India on the decline, Asia Pacific on the decline, depending on where you are. Japan is elevated, Vietnam starting to come down. Same with Thailand. I think people are getting tired of COVID, as I think many are. But when you look at what Omicron, what the impacts are, what kind of problems there are, they're not as severe. People are getting a bit more comfortable. We're starting to come into warmer weather in the U.S. People are outside more, easier to keep distance. Again, a lot of these things will be a positive as it fades into the background. Now, when you look at pad 3, you can see that crude oil is right at the 2020 level. So very, very normal spot. There's nothing really bullish or bearish. We're pretty much right, down the middle. We do expect this to continue, as we were saying last week, to follow that 2020 kind of rise. When you look at what happened in 2018, 2020, it's very normal to see that. So there's nothing, we're not making any huge call. It's just a seasonal normal build in pad 3, which we think is very likely. When you look at Cushing, we're back down to 2012 levels. So we've been here before, but it doesn't change the fact that it is a bullish backdrop. We were expecting to be a bit closer to, when you look at that 2010, we thought it was going to be more along the lines like 2020. You can see where it kind of goes sideways, and then starting now, it started to drift higher. Instead, we're just continuing to drift lower. And that's going to be an important one to watch when you start looking at spreads, start looking at ways to look at the curve in general, because the export market, now we did get a decent sized move of exports, but that was kind of the last hurrah. And now we have some pressure coming just because we're approaching a $5 spread between Dubai, which again is just going to put more pressure on U.S. crudes going to Asia. The fact that you have Europe avoiding Urals a bit now and starting to weigh what happens with sanctions, that will help some of the U.S. flows. So that'll help offset what's happening out of Asia. But those are some of the shifts that we're starting to see on the physical front. But right now we will get that decline in the near terms out of the U.S. Floating storage, we were expecting it to stay fairly flat. Instead, it fell back out of the lower end of the cloud. We do expect this to bounce back up and come closer to the highs that we saw from last week. And then when we look at imports into pad 3, so we were expecting it to go a bit higher and not to obviously get back to the 5-year average, but we were expecting it to come back up further into the cloud. And you can see here that it increased, but it's still at a very low end. And we do expect that to increase going forward. So then when you look at imports into pad 2, we were expecting a little bit of a drop along those seasonal lines, still well above the 5-year average, still well at the top end of the cloud. Instead, things still remain very strong. There's a bit of lumpiness, so we do expect to see a little bit of a decline. but a lot of those imports remaining bullish. Here you can see we're turning lower. We're now keeping pace with that 29-year average, and we don't see that changing. We expect it to follow that 29-year average pretty closely as we go through the remainder of turnaround season. So now in the next segment, we're going to go through some of the specifics on U.S. products, U.S. demand, what are some of the things that we're seeing, and provide some color on what comes over the next few weeks.